Imagine having a playbook straight from one of the world's most brilliant investors, a strategy that turns the complex world of banking into a roadmap for financial security. Stanley Druckenmiller, renowned for his uncanny ability to read markets and anticipate economic shifts, isn't just talking about big hedge fund moves. He's offering insights that retirees can actually use. In an era of unpredictable interest rates and volatile markets, understanding how to position your money like Druckenmiller can make the difference between watching your savings shrink or letting them grow steadily. This is more than theory. It's a practical strategy designed to protect your nest egg while keeping opportunities open for smart growth. Focusing on capital preservation over chasing high returns is a principle that separates the most successful investors from those who get caught in the excitement of market hype. For retirees, this is not just a theoretical concept, it's a lifeline. In the world of finance, it's easy to be seduced by stories of outsized gains and aggressive strategies, but the reality is that high returns almost always come with high risk. And when retirement savings are at stake, risk isn't just a number on a spreadsheet. It's your daily security and peace of mind. Stanley Druckenmiller's approach has always been to protect the foundation before building the tower. Without a solid base, even the most lucrative opportunities can collapse in an instant. This mindset is crucial for retirees who no longer have decades to recover from a misstep in the markets. The thrill of a rapid return may be tempting, but the cost of losing a significant portion of your nest egg is permanent and irreversible, making caution not a limitation, but a form of empowerment. Capital preservation doesn't mean avoiding growth. It means prioritizing the survival of your assets so that growth, when it occurs, compounds safely. Retirees often face the dual challenge of needing income from their savings while also keeping those funds intact for the long term. High-yield investments, flashy banking products, or speculative ventures may promise more, but they introduce volatility that can wipe out years of careful planning in a matter of months. Druckenmiller's strategy emphasizes understanding the underlying risk, not just the potential reward. Every decision should start with the question, if this move goes wrong, how much am I willing to lose? And can I afford that loss without disrupting my lifestyle? In retirement, the stakes are higher, and the tolerance for loss is far lower than during the accumulation years. By focusing first on capital preservation, retirees align their strategy with the reality of their needs, ensuring that their money works safely for them rather than against them. One of the most compelling aspects of this approach is that it requires discipline and patience, qualities often overlooked in a world obsessed with instant gratification. The human instinct is to chase trends, to believe that the next big opportunity will solve all financial concerns. Yet Druckenmiller's philosophy teaches that the markets are not a casino. They reward careful observation, timing, and respect for risk. For retirees, this translates into a strategy that prioritizes investments in low volatility, stable instruments, products that may not make headlines for explosive returns but are reliable in preserving the value of savings. Certificates of deposit, high-quality bonds, and insured banking products form the backbone of this approach, offering a predictable income stream while minimizing exposure to sudden market shocks. This is the difference between surviving a financial storm and being swept away by it, and it's a lesson that retirees cannot afford to ignore. Understanding the principle of capital preservation also reshapes how retirees perceive opportunity. Instead of asking how much they can gain in a short period, they begin to ask how much they can safely maintain and grow steadily. Every decision is filtered through a lens of security and sustainability. Even when exploring more dynamic investments, such as equities or real estate, the guiding rule remains exposure should never threaten the core of your financial stability. Druckenmiller has often spoken about the importance of flexibility and adaptability, and for retirees, this means structuring portfolios in a way that allows for responsive adjustments without compromising essential capital. It's a mindset that replaces fear of missing out with the confidence of knowing that the foundation is secure, no matter what market turbulence arises. Risk management, an intrinsic part of capital preservation, requires constant vigilance. Retirees must be attuned not only to individual investment risks, but also to macroeconomic conditions, interest rate fluctuations, inflation trends, policy changes. Druckenmiller's career is a testament to the power of observing these external factors and using them to protect and optimize capital. By staying informed and proactive, retirees can avoid scenarios where a sudden downturn erodes years of savings, instead making deliberate moves that maintain stability. Monitoring the environment allows for incremental adjustments that enhance safety while still allowing room for measured growth. This is where patience intersects with intelligence, creating a dynamic in which capital is preserved not through avoidance but through strategic positioning. The psychological aspect of capital preservation cannot be overstated. Retirees face a unique tension: the desire to maintain a comfortable lifestyle versus the fear of depleting their resources. This anxiety can lead to impulsive decisions or overcautious stagnation. Druckenmiller's approach helps reconcile these forces by promoting a framework that is both disciplined and flexible. By anchoring strategies in the preservation of capital, retirees gain the confidence to make decisions without panic or haste. Understanding that the primary goal is continuity and security, this mindset transforms how retirees view financial planning, turning it from a series of reactive choices into a deliberate, empowered process where every action contributes to long-term stability and peace of mind. Capital preservation, therefore, is not merely a defensive tactic, intelligent strategy. It's about creating a financial environment where growth can occur safely, income is reliable, and the inevitable uncertainties of life do not threaten the lifestyle you've worked decades to achieve. It demands awareness, discipline, and a willingness to prioritize long-term security over short-term thrill, a mindset that Druckenmiller has exemplified throughout his career. For retirees, adopting this principle changes everything. It reframes how they see risk, opportunity, and the very purpose of their savings, allowing them to move through retirement with both confidence and control. Taking advantage of rising interest rates strategically is a tactic that can transform the way retirees manage their banking and investment decisions. When interest rates climb, the financial landscape shifts in ways that can either erode wealth or create significant opportunities, depending on how you position yourself. Many retirees approach rising rates with fear, worried that their bonds or savings accounts will lose value or that borrowing costs will spike. Druckenmiller, however, views such moments as signals for action, an opportunity to leverage shifts in the economic environment rather than be victimized by them. For those living on fixed incomes or relying on nest eggs to sustain retirement lifestyles, understanding the mechanics of interest rate movements becomes crucial. By observing trends and timing moves carefully, retirees can position their assets to earn more from cash holdings, take advantage of higher yield banking products, and even improve income streams without taking on excessive risk. This approach transforms uncertainty into a tactical advantage, offering the kind of financial agility that can redefine retirement security. Rising interest rates directly influence the returns on traditional banking products like savings accounts, certificates of deposit, and money market funds. For retirees, these instruments suddenly become far more attractive because they provide safe, predictable income without exposing the capital to market volatility. Instead of chasing high-risk assets in hopes of beating inflation, retirees can now earn meaningful returns on stable investments. Druckenmiller's insight is that while many investors panic during rate hikes, the disciplined observe the broader context raised in response to economic growth, inflation pressures, or central bank policy shifts. Each of these factors can be interpreted, measured, and used to make informed decisions about where to allocate money. Retirees who act strategically in such periods can convert a potential threat into a reliable source of income, strengthening the foundation of their retirement plan. The advantage of rising rates extends beyond income. It also reshapes the calculus for debt and leverage. Retirees who may carry mortgages, home equity lines, or other financial obligations see the cost of borrowing increase, which can be discouraging at first glance. Yet Druckenmiller's approach emphasizes understanding timing and structure. Fixed-rate debt incurred before rate increases becomes more valuable, as it locks in costs at lower levels, while variable-rate debt must be managed carefully. Moreover, rising rates often correlate with better yields on short-term instruments, allowing retirees to reinvest maturing assets into products that offer higher returns. This creates a dynamic where careful planning and tactical adjustments allow savers to navigate the shifting environment without surrendering financial stability. The key is knowing when and how to reposition funds so that your capital benefits from the changing rates instead of being diminished by them. Another critical element is the interplay between interest rates and inflation. Rising rates are frequently a tool to combat inflation, yet inflation itself erodes purchasing power if not managed proactively. Druckenmiller's strategies illustrate how retirees can balance these forces by choosing banking and investment vehicles that both protect capital and enhance income. For instance, short-term Treasury securities or floating rate notes can respond to rising rates, keeping returns ahead of inflation while safeguarding principal. This approach requires attentiveness and readiness to move quickly, but for retirees who embrace the mindset, it transforms a challenging economic period into one of opportunity and growth. The thrill comes from mastering complexity, turning what many perceive as financial turbulence into a carefully navigated advantage. Timing is an essential factor in this strategy. Retirees must be alert to signals from central banks, market trends, and macroeconomic indicators that suggest rate movements. Druckenmiller's expertise underscores the importance of observing patterns rather than reacting impulsively. By monitoring key economic data, such as employment reports, consumer spending trends, and bond market yields, retirees can anticipate shifts and act proactively. This proactive stance is what separates those who merely survive periods of rising rates from those who thrive. It is not about predicting the future with certainty, but about positioning oneself intelligently so that the financial outcome is favorable regardless of minor fluctuations. Each move is calculated, each adjustment deliberate, and each decision rooted in preserving and enhancing capital while remaining flexible enough to respond to unexpected turns. Rising interest rates also influence the broader investment environment, affecting stocks, real estate, and alternative income sources. Retirees who remain focused on capital preservation and income optimization must recognize how these shifts interact across different asset classes. For instance, higher rates may reduce the attractiveness of long-duration bonds or highly leveraged real estate investments, while simultaneously making short-term deposits and floating-rate instruments far more rewarding. Druckenmiller's approach teaches that financial environments are interconnected, and success comes from understanding these interrelationships rather than treating each investment in isolation. Retirees who adopt this holistic perspective can construct a portfolio that balances safety, income, and strategic exposure to opportunities, all while maintaining the protective principles that underpin capital preservation. Psychologically, embracing rising interest rates strategically requires a shift in mindset. Many retirees instinctively fear change, especially when it threatens the predictable income they rely on. Yet Druckenmiller's philosophy encourages viewing shifts not as threats, but as tools to be used intelligently. With rising rates, retirees gain leverage. They can achieve higher returns safely, make tactical adjustments to cash flows, and protect against inflation's silent erosion. This mindset transforms anxiety into confidence, allowing retirees to move decisively in a complex economic landscape. The ability to see opportunity where others see risk is a hallmark of disciplined investing, and for retirees, it can mean the difference between stagnating wealth and a financially vibrant, adaptable retirement. Diversifying across safe banking products and short instruments is a principle that turns uncertainty into a strategic advantage, especially for retirees who can no longer afford to gamble with their financial security. While capital preservation and leveraging rising interest rates provide strong foundations, Diversification ensures that no single misstep can jeopardize the entire nest egg. Druckenmiller's approach to diversification is not about spreading money thinly across dozens of options, but about intelligently allocating assets to products that offer stability, liquidity, and predictable returns. For retirees, this might mean balancing high-quality savings accounts, short-term certificates of deposit, money market funds, and government-backed securities, creating a portfolio that is resilient in any economic environment. By carefully choosing instruments that complement one another, retirees gain a level of protection that goes far beyond the superficial safety of a single bank or account. Short-term instruments are particularly valuable in this strategy because they provide flexibility and responsiveness. Unlike long-term commitments that lock money away for years, short-term options allow retirees to reposition their funds in response to market movements, interest rate changes, or personal needs. This aligns perfectly with Druckenmiller's philosophy of adaptability. He consistently emphasized the importance of maintaining the ability to act decisively when circumstances change, and short-term instruments embody this principle. For example, a 3 or 6 month certificate of deposit might yield slightly less than a longer-term option, but it offers the freedom to reinvest at higher rates once the term matures. In retirement, this flexibility is not just convenient, it can significantly increase total returns over time, while safeguarding principal against sudden market shocks. Diversification also mitigates psychological stress, which is often underestimated in retirement planning. Knowing that money is spread across multiple securities reduces the fear of a single point of failure. Many retirees experience anxiety when economic news suggests volatility, fearing that their entire savings could be wiped out by one unexpected event. By distributing funds among various banking products, retirees create a buffer against these fears. Druckenmiller's investment highlights the psychological edge gained through disciplined planning. When you know your assets are carefully diversified, you make decisions from a position of confidence rather than panic. Every product added to the portfolio is a layer of security, a calculated step toward financial peace of mind. Another dimension of diversification is balancing income, generating instruments with those that preserve liquidity. Some products, such as money market funds or short-term treasury bills, provide easy access to cash while earning modest returns. Others, like high-quality certificates of deposit, offer slightly higher yields but require locking in funds for a set period. By combining these elements thoughtfully, retirees can maintain immediate access to cash for emergencies or opportunities while also benefiting from higher returns on committed capital. This dual approach mirrors Druckenmiller's methodology: secure the base while leaving room for strategic action. It's a dynamic balance that keeps retirees prepared for both expected expenses and unforeseen events, making financial management far more proactive than reactive. The thrill of this strategy comes from its responsiveness. Unlike static retirement portfolios that are set and forgotten, a diversified collection of safe banking products and short-term instruments invites engagement and decision-making. Retirees can monitor interest rate movements, reinvest matured assets, and adjust allocations to maximize returns without ever exposing themselves to dangerous risk. This continuous cycle of assessment and adjustment transforms retirement finances from a passive concern into an active, empowering pursuit. Druckenmiller often spoke about the importance of reading market signals and adapting accordingly. For retirees, diversification across short-term, safe instruments is the practical embodiment of this philosophy. It turns careful observation into tangible action, providing both security and the thrill of strategic control. Furthermore, diversification reduces dependency on any single banking institution or product type. Economic crises, regulatory changes, or unexpected shifts in the market can affect specific banks or instruments, and being overexposed to one source of funds can be catastrophic. By spreading capital across multiple types, retirees create a network of financial safety that is resilient to external shocks. Druckenmiller's principles emphasize understanding systemic risk and positioning assets to minimize vulnerability. Diversification in this context is not just prudent, it is an active defense, ensuring that retirement plans remain intact even when unexpected disruptions occur. The mathematical advantage of diversification is also compelling. By allocating funds across multiple safe instruments with varying maturities and yields, retirees can smooth income over time, avoiding periods of low returns that could strain monthly budgets. A portfolio with overlapping maturities and staggered terms ensures that capital is regularly replenished and reinvested at optimal rates. This methodical structure mirrors Druckenmiller's disciplined approach to risk-adjusted returns. Each decision is evaluated not only for potential gains but for the timing, safety, and contribution to overall financial stability. Retirees gain predictability without sacrificing growth, achieving a balance between security and opportunity that is both rare and valuable. Finally, diversification fosters a mindset of adaptability and control. Retirees who embrace this principle stop viewing financial markets as unpredictable threats and start seeing them as systems that can be navigated with knowledge, discipline, and timing. Every short-term instrument, every diversified allocation, becomes a tool in a well-crafted strategy, a way to harness the principles Druckenmiller used at the highest levels of investing and apply them to personal finance. This approach combines prudence with engagement, turning what might otherwise feel like a vulnerable stage of life into a period of empowered decision-making, where risk is managed intelligently, income is optimized, and capital is preserved strategically. Keeping liquidity available for opportunistic investments is a principle that transforms a retiree's financial strategy from passive preservation to proactive empowerment. While diversification and short-term instruments provide a foundation of safety, liquidity is the lever that allows retirees to seize opportunities as they arise without jeopardizing core assets. Stanley Druckenmiller has always emphasized the importance of flexibility and being ready to act when conditions are favorable, and this mindset applies just as powerfully to retirement finance. Liquidity is not simply cash on hand, it's the ability to move swiftly and decisively, to allocate capital to high-probability opportunities while the market presents them, and to do so without panic or delay. In retirement, this can mean the difference between missing an income, enhancing opportunity, and strategically increasing returns with minimal risk. Opportunistic investments in a rising or shifting economic environment require both preparation and foresight. Many retirees lock funds into long-term instruments or illiquid assets, leaving themselves with little room to maneuver when advantageous situations arise. Druckenmiller's approach teaches that timing and agility are crucial, and that the ability to respond quickly to new opportunities is often more valuable than chasing every high-yield option. Keeping a portion of your portfolio liquid ensures that when a sudden change occurs, such as an unexpected interest rate spike, a temporarily undervalued safe banking product, or a short-term government security with an attractive yield, you can act decisively. This strategy converts awareness into action, turning knowledge about the market into tangible financial advantage. The concept of liquidity extends beyond simply having cash in a checking account. It involves structuring a portfolio with instruments that are easily accessible, predictable in value, and capable of being deployed without incurring penalties or losses. Short-term certificates of deposit, high-quality money market funds, and treasury bills are ideal vehicles for this purpose. Each of these provides both security and accessibility, allowing retirees to shift funds quickly while maintaining the overarching principle of capital preservation. Druckenmiller has consistently highlighted the importance of being ready to capitalize on temporary inefficiencies in the financial system, and retirees who maintain liquidity are effectively following the same principle at a personal level. They create a buffer that allows them to move dynamically rather than being constrained by rigidity. Psychologically, liquidity offers confidence and reduces anxiety. Many retirees fear locking too much capital into fixed or long-term investments, worried about unexpected expenses or sudden changes in the market. Having liquid funds accessible for opportunistic investments provides both a safety net and a sense of control. It allows retirees to act when conditions are favorable rather than reacting under stress when circumstances are less advantageous. Druckenmiller's philosophy underscores that a key advantage in any market is emotional composure, and liquidity directly supports this by giving retirees the ability to make calculated, unemotional decisions. With liquid resources, every opportunity can be assessed on its merits rather than being filtered through the lens of desperation or constraint. Opportunistic investing also element of strategic excitement into retirement finance. Retirees are often told to adopt a conservative, static approach focusing solely on preservation and slow growth. While these principles are important, liquidity allows for calculated engagement with the market, turning observation and knowledge into actionable steps. For instance, when a short-term instrument offers an unusually high yield due to temporary market conditions, liquid capital can be deployed immediately to capture the benefit. This ability to respond quickly creates a dynamic where retirees feel empowered and in control rather than passive observers of economic changes. Druckenmiller's career demonstrates that wealth is often made by those prepared to act when conditions favor them, and the same lesson applies to personal retirement strategy. Strategically, maintaining liquidity also enhances portfolio resilience. Markets and banking environments, static and even safe instruments can be affected by macroeconomic factors, regulatory shifts, or sudden policy changes. By ensuring that a portion of assets remains liquid, retirees have the flexibility to adjust allocations without compromising the security of their core savings. They can move into higher yield opportunities, rebalance portfolios in response to interest rate changes, or cover unexpected expenses without selling long-term instruments at a loss. This flexibility reduces exposure to timing risk and creates a system where control, rather than chance, governs outcomes. It is a practical embodiment of Druckenmiller's insistence on adaptability and proactive risk management. Liquidity also allows retirees to exploit temporary market anomalies that appear unpredictable to most investors. Often, short-term fluctuations create windows of opportunity in safe banking products, bonds, or treasury instruments, where yields spike or conditions briefly favor certain positions. Without liquid funds ready to act, these opportunities vanish, leaving the retiree with a sense of frustration and lost potential. With preparation, however, the retiree can allocate capital quickly, secure favorable returns, and then reinvest as conditions continue to evolve. This approach is not speculative in a risky sense. It is tactical, deliberate, and firmly anchored in the principles of safety, capital preservation, and disciplined observation that Druckenmiller champions. Furthermore, liquidity facilitates a cyclical approach to retirement finance. Retirees can continually assess, redeploy, and optimize funds as short-term opportunities arise. Each action is measured, calculated, and consistent with the overarching strategy of preserving the core nest egg while enhancing income and growth where possible. This approach transforms retirement from a static phase into an active period of strategic engagement, where knowledge, timing, and foresight create tangible financial advantages. By maintaining liquidity, retirees embody the principle that flexibility is not just a convenience. It is a tool for control, empowerment, and financial success. Avoiding locking into long-term, low-yield commitments is a strategy that empowers retirees to maintain control over their financial future while capitalizing on more favorable opportunities. While many traditional retirement plans emphasize security through long-term investments, these instruments can become traps in a changing economic environment, especially when interest rates rise or market conditions shift unexpectedly. Stanley Druckenmiller's approach teaches that flexibility is just as important as stability. Committing too heavily to low-yield, long-term options can severely limit one's ability to act decisively when better opportunities arise. For retirees, this principle is particularly crucial because the ability to adapt to market changes and new banking opportunities can directly affect income, lifestyle, and the preservation of hard-earned capital. Long-term, low-yield commitments often seem safe at first glance. Products like multi-year certificates of deposit or bonds with fixed, Modest returns give the appearance of security, providing predictable income streams and a sense of stability. However, these instruments carry hidden costs, especially when economic conditions evolve. When interest rates rise, for instance, the fixed returns of long-term investments suddenly look far less attractive compared to newly available instruments offering higher yields. Retirees who have locked significant capital into these older products find themselves missing out on income potential, and the opportunity cost can accumulate quickly. Druckenmiller's philosophy underscored the importance of observing macroeconomic trends and maintaining the agility to redeploy capital when conditions are advantageous, a principle that long-term low-yield commitments inherently restrict. The dangers of locking into these commitments are amplified during periods of financial volatility. Even instruments traditionally considered safe can lose relative value in a changing rate environment. A bond yielding 3% annually, purchased when rates were low, may look secure, but if new bonds offer 6%, the retired investor is effectively leaving money on the table. This missed potential is more than just a minor inconvenience. It directly impacts cash flow, the ability to respond to emergencies, and the overall growth trajectory of retirement savings. Druckenmiller's strategy is to anticipate these shifts of position assets to respond dynamically, emphasizing that security is not static, but rather a moving target that requires awareness and adaptability. Avoiding low yield, long-term commitments keeps retirees agile, able to respond to fluctuations without sacrificing core capital. Flexibility also plays a psychological role in retirement planning. Committing to long-term, low-yield investments can create a false sense of security, lulling retirees into complacency and reducing engagement with their financial management. Druckenmiller highlights that awareness and this are critical to successful investing, and a portfolio locked into fixed, low-return products discourages both. Retirees who maintain the ability to relocate funds of advantage of emerging opportunities retain the confidence and control that are essential to navigating financial challenges. This mindset transforms retirement from a period of passive maintenance into a stage of strategic action, where informed decisions directly enhance income, protect assets, and optimize growth potential. Another critical dimension is the relationship between low-yield commitments and inflation. Over time, even modest inflation can erode the purchasing power of returns from long-term low-yield investments. A retiree relying on a fixed 2% or 3% return may find that their effective income diminishes year after year as costs rise, creating a hidden financial pressure. Druckenmiller's approach emphasizes the importance of adjusting strategy in response to real economic conditions, recognizing that preservation of capital must be paired with attention to real purchasing power. Avoiding long-term, low-yield traps allows retirees to redeploy funds and instruments that better keep pace with or exceed inflation, ensuring that lifestyle and security are not compromised by stagnating returns. The principle also encourages a dynamic allocation approach, blending safety, income, and tactical opportunity. By avoiding overly long-term commitments, retirees can stagger maturities, take advantage of short-term instruments, and remain responsive to interest rate fluctuations. Certificates of deposit with shorter terms, high-quality money market funds, and treasury bills allow retirees to adjust positions frequently, capturing higher yields when available while maintaining the underlying safety of capital. This method reflects Druckenmiller's philosophy of timing and precision. Success is not merely about selecting the right instruments, but about knowing when to enter, exit, or reposition capital to optimize both security and return. Moreover, avoiding long-term, low-yield commitments aligns you of liquidity and opportunistic engagement. When funds are tied up in inflexible products, the ability to act on transient opportunities, such as temporarily high-yield banking products or market dislocations, is lost. Druckenmiller's insight is that adaptability is often more valuable than the incremental returns promised by static investments. By keeping funds available and positioned to respond, retirees maintain the freedom to capture advantages that arise from interest rate changes, economic cycles, or short-term market inefficiencies, converting awareness into tangible benefits. This strategy also enhances portfolio resilience by preventing concentration risk. Tying too much capital into low-yield, long-term instruments expose us in rates, inflation, or institutional changes that can reduce returns or limit options. By deliberately avoiding such commitments, retirees distribute risk across flexible, shorter-term, higher-yield instruments, achieving balance between security, income, and adaptability. Druckenmiller's principles emphasize of mitigating vulnerabilities while remaining positioned to exploit favorable conditions, a dual objective that is particularly vital during retirement when recovery from financial missteps is more difficult. Finally, avoiding long-term, low-yield commitments encourages an active, attentive mindset. Retirees who embrace this principle stay engaged with their financial environment, consistently evaluating rates, maturities, and market signals to maximize returns and preserve capital. Each decision becomes intentional, informed by both strategy and context, reflecting Druckenmiller's insistence on combining discipline, observation, and tactical agility. By refusing to be trapped in inflexible, low-return investments, retirees maintain control over their financial destiny, ensuring that both security and opportunity remain within reach. Monitoring economic indicators to adjust your banking strategy is the final pillar that transforms a retiree's financial approach from reactive to proactively intelligent. While preserving capital, leveraging rising interest rates, diversifying across instruments, maintaining liquidity, and avoiding long-term low commitments provide a robust foundation. None of these tactics operate optimally without awareness of the broader economic environment. Stanley Druckenmiller built his reputation not only by taking decisive action, but by interpreting subtle signals in the markets, anticipating shifts before they became obvious, and positioning capital advantageously. For retirees, adopting a similar mindset means staying alert to key economic indicators, understanding what they imply for banking products and short-term instruments, and using this information to make timely adjustments that safeguard and enhance wealth. Economic indicators are essentially the pulse of the financial system. Interest rates, inflation figures, employment data, consumer confidence, and central bank communications all convey signals about where the economy is heading. Druckenmiller's approach relies heavily on interpreting these signals, recognizing patterns, and predicting how these macroeconomic trends affect asset classes. For retirees, this is no less critical. A spike in interest rates might signal an opportunity to reinvest maturing short-term instruments at higher yields. Rising inflation could indicate the need to move funds into products that maintain purchasing power. Conversely, signs of economic slowdown might encourage more conservative positioning, focusing on capital preservation and liquidity. The ability to read and act on these indicators creates a strategic edge that passive retirement strategies often lack. One of the most important indicators for retirees is interest rate movement. Rates fluctuate in response to central bank policy, inflation, and overall economic growth. Each shift has a ripple effect across banking products, bonds, and other fixed income instruments. Retirees who monitor these trends can anticipate how yields on certificates of deposit, treasury bills, and money market funds will adjust, enabling them to time investments to capture higher returns. Druckenmiller's insight highlights that the timing of capital deployment is as important as the choice of instruments. In retirement, acting too late can mean locking in lower yields and missing the chance to grow income efficiently, while acting too early without proper analysis can compromise security. By paying attention to interest rate trends, retirees gain the ability to optimization with the preservation of principal. Inflation is another critical factor to monitor. Even modest inflation erodes the real value of savings over time, diminishing purchasing power and affecting lifestyle. By tracking inflation data, retirees can adjust their allocation toward instruments that protect capital while maintaining income streams that outpace rising costs. Druckenmiller's strategy emphasized not just reacting to inflation after it has occurred, but anticipating its trajectory based on economic reports, commodity prices, and central bank policies. For retirees, this forward-looking approach allows them to proactively redeploy funds, favoring flexible, high-yield short-term instruments over stagnant, long-term commitments. Monitoring inflation becomes a tactical advantage, providing insight into when and where to invest for both safety and growth. Employment and consumer spending data also provide valuable context. High employment levels often signal robust economic activity, which can drive interest rates higher and create opportunities for reinvestment in banking products that respond to rate increases. Conversely, weakening employment or declining consumer confidence might suggest slowing economic growth, prompting retirees to emphasize capital preservation and liquidity. Druckenmiller's methodology underscores that economic signals rarely exist in isolation; they interact, creating complex patterns that informed investors can interpret to their advantage. For retirees, the thrill lies in connecting these dots, translating macroeconomic observations into actionable steps that optimize portfolio performance while safeguarding stability. Central bank communications are another essential source of insight. Statements, policy reports, and meeting minutes often contain subtle clues about the direction of interest rates and monetary policy. Retirees who cultivate the habit of reviewing these communications can gain an early warning about shifts that will impact banking products. Short-term instruments and yield structures. Druckenmiller consistently leveraged such signals in his hedge fund strategies, acting decisively when the market had not yet fully priced in the information. In retirement, this same principle applies on a smaller, but no less impactful scale. By staying informed, retirees can make timely adjustments that secure higher yields, avoid locked-in low returns, or reposition capital to mitigate risk. Monitoring economic indicators also enhances psychological control over financial decisions. Many retirees experience anxiety when headlines signal market turbulence or inflation spikes. By regularly tracking key data points, retirees replace uncertainty with understanding. Druckenmiller's approach shows that knowledge reduces panic and enables measured action. Every adjustment made in response to economic indicators is deliberate, not impulsive, and is anchored in an awareness of broader trends rather than reactive emotion. This creates confidence, empowering retirees to manage portfolios dynamically while remaining aligned with their primary goals of capital preservation and income optimization. Another advantage of observing economic indicators is the ability to anticipate temporary market inefficiencies. Shifts in rates, inflation expectations, or policy adjustments often create windows where short-term instruments and banking products offer unusually favorable returns. Retirees with liquid capital and a diversified portfolio can act decisively to capture these gains. Echoing Druckenmiller's principle of exploiting temporary anomalies, these opportunities are fleeting, and without active monitoring, they are easily missed. The ability to seize them can meaningfully enhance income while maintaining the core safety of retirement funds. Finally, integrating economic indicators into a retiree's banking strategy encourages continuous engagement. Retirement is often portrayed as a time to step back from financial management. Yet strategic monitoring ensures that the portfolio evolves in line with real-world conditions. By tracking interest rates, inflation, employment data, and central bank signals, retirees create a feedback loop of observation, adjustment, and optimization. This proactive stance embodies Druckenmiller's philosophy at a personal level, transforming retirement finances from passive preservation in an intelligent, responsive system where knowledge, timing, and flexibility generate both security and growth.